Hi, this is Justin Nielsen with Investors Business Daily. In this video session, we're going to be talking about the markets. Basically, with your swing trades, the markets are such a critical component to determine if you're going to be successful or failure with your individual stock picks. So, first of all, what do we determine is the leading index at any given time for our market analysis? Well, a good thing to start with is who's leading? Who's making the most money? Who's making the most progress in terms of its performance? So if you take a look at this chart of the 2018 time period, you'll see that right now the NASDAQ Composite is our leading index. It's far outperforming the Russell 2000, which is our small cap index, and the S&P 500. The Dow Jones Industrial Average is also right around the same level as the S&P 500, but not shown on this chart. So once you determine that the NASDAQ Composite is where you want to focus your attention, now you need to do some analysis of what direction that market is going in. On investors.com, the swing trader product, we do have a specific market action area that basically does a lot of this analysis for you. We talk about what's happening on any given day, what the leading stocks are doing, and whether or not the market is in an uptrend, a sideways market, or a downtrend. These are going to be the critical components to determine how you should be handling your trades. In an uptrend, that's where you're going to be doing most of your buying. In a downtrend, that's where you might do some shorting, because if the market is establishing a downtrend, some of the shorts are going to be working and you can still make progress in your portfolio while the market is going down. Sideways markets, that's where you're going to really be very cautious. And in fact, a lot of times you're going to want to sit that out entirely. In sideways markets, less is more. The less trading you do, smaller position sizes, the better. Okay? So let's take a look and see how the market action on Swing Trader handled a few of the recent activity in 2018. And I'll start with January, because in January we had a very nice rally through most of the month. But at the end of the month, we started to see some topping action. And here's what we wrote in Swing Trader. Our activity in Swing Trader diminished to finish out the month, and we noted the extended nature of the market coupled with flawed setups, and we advised more caution and less activity. What happened after that? Well, on February 1st, we had our last trade get sold. That was NVIDIA, and the market proceeded to have an 11.7% correction in the NASDAQ Composite. Now, it quickly came back, and by February 14th, after the February 9th low, we were already starting to turn that back to an uptrend. But this is why shorting is something that you need to make sure has a downtrend established. If you try and short too quickly, you can get that run up right back into your trading and lose a lot of money. So that's what happened in February. We got to new highs quickly in March, kind of went sideways for a little bit and came back down. Let's go ahead and fast forward to June, because in June, we also saw a very strong rally in June. And here's what we said in Swing Trader as we started to see topping action there. On June 22nd, market action continued to decline on Friday, prompting a shift in the market trend to sideways. We noted that oil wasn't enough to keep the S&P 500 at new highs, because the S&P 500 was getting a big boost from oil and was starting to show some leadership at that time. And meanwhile, the NASDAQ Composite continues to close below its 10-day moving average. That's the green line on this chart. And since we're doing swing trading and our average length of time that we're holding these stocks is around 10 days, it makes sense that we would use the 10-day moving average as our time frame. When you start to see that 10-day moving average going up, that lets you know what kind of trend you're in. When you start to see it flattening out, or when you see the NASDAQ Composite or whatever market you're looking at trade below the 10-day moving average, that lets you know that you're probably in for some more trouble. Okay? So what happened with the NASDAQ after that point was we basically have been trading in this sideways range, and it's been very difficult to make headway in individual stocks. You buy a stock, and then pretty soon the market has a reversal, a bearish reversal, and then you're underwater and you're getting knocked out of stocks. So that's why it's usually better for less is more in those environments. Have mostly cash. You might put on a couple test trades, but you don't want to be very aggressive in your buying, and you might even reduce your position sizes in that time frame. Okay, now let's go ahead and take a look at shorting. Shorting is not something that we've been doing recently because we haven't really had a downtrend get established. Now, if you go back to 2016, if you looked at the 50-day moving average, in this case on the chart it's a red line, or the 200-day moving average, in this case that's the black line, you can see that there was a lot more activity of these lines going either up, flat, or down. And the down and flattening is what we're particularly interested in, like with the 200-day moving average or the 50-day moving average when you're wanting to short. You want that downtrend to be more established. You want downtrends established in your stocks, and you just want to be playing part of that overall trend with your shorting. And a lot of times with our shorting, we're going to be very quick to take our profits. We get 5% profit, a lot of times we're out. We're just trying to get a little bit of extra momentum in our portfolio while the market is taking its breather and in a downtrend. So for more information on this market action component, you can always go to investors.com/swingtrader, because we do show you how we look at the market on a daily basis. I hope that's been helpful, and good trading.